Even though the frontline indices, the S&P BSE Sensex and the Nifty 50 are set to post a double-digit return for the second consecutive financial year in 2021-22 with a gain of 16% and 18% respectively, it is the small caps where all the action was concentrated in the year gone by. The small cap index on the BSE has surged 35% thus far in FY22, far outpacing the gains in S&P BSE mid cap and the BSE 500 indexes that moved up 18% and 20% respectively during this period. The small cap rally was driven by improved earnings and strong inflows from domestic investors in local equities. Domestic mutual funds have seen a record net inflow of 1.73 trillion rupees in FY22. FPIs, however, reported a record net outflow of 1.42 trillion rupees during this period, the National Security Depository Limited data shows. Despite the strong show, most analysts expect the markets to remain choppy in FY23 amid multiple headwinds. The ongoing geopolitical crisis between Russia and Ukraine, they feel, will keep commodity prices, especially crude oil, elevated, which in turn will keep stock market gains in check. Persistent inflation in the US and an increasingly hawkish US Federal Reserve are negative for global equity markets, said VK Vijay Kumar, Chief Investment Strategist at Geojit Financial Services. US dollar index at 99 levels and the 10-year bond yields at around 2.5% too are areas of concern. Listen into what he said.
For FY23, the returns look promising, but there are headwinds. Persistent inflation in the US and an increasingly hawkish Fed are negative for global equity markets. Global US dollar index at 99 and 10-year bond yield, the US 10-year bond yield at around 2.5% are areas of concern for global equity markets. India is relatively better placed, even though the spike in crude will impact GDP growth and inflation. The impact will be not very severe, it will be modest. And for India, there is a strong rebound in growth now, and earnings recovery can be expected to continue the momentum.
Vishad Torakia, Director, Securities at Equirus, suggests investors remain stock-specific. This is what he advises.
So what do we expect going into FY23? We feel that the volatility in the markets is likely to continue, given inflation pressures, which will also lead to margin compressions in the coming quarters. So we expect the market to be stock-specific and sector-specific. High inflation and oil-driven impact on imports is likely to impact growth as well, which is already fragile. Once the dust settles, because there's a LIC IPO impending, which will act as a confidence booster to domestic equities and bring in much needed dollar inflows. In addition, attractive valuation could drive inflows both from domestic and external side. Our preferred sectors would be industrials, capital goods, real estate, building materials.
On Thursday, the last day of expiry for future and option series for March, the markets are likely to remain range-bound amid volatility. That apart, the financial year end on March 31st will also weigh in on investors' minds as they book profit or loss on their investments for the fiscal year gone by.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.